Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, for example, here's my stage one way down here at between 101.50 and 107.38 or so. That was that early range, early in the year. You'll notice now I've put stage two here. I've put on two moving averages. The 30-weighted moving average, which is the moving average that I always use, okay, based on this method, I always use a 30-weighted moving average. It's kind of like a condition to buy or condition to sell. So I need to have that 30-weighted moving average either in the lower trading range to plan for a breakout or by the upper trading range to use as a trailing stop. And though I have a big range up here between 142 and 165 and a possible top due to the size of the range, I actually added a 10-weighted moving average, and I added that for anybody that wants to be like a trader. Okay, so an investor would use your 30-weighted moving average, and I basically would have to wait for that 30-weighted moving average, which is right now at about 125, to catch up to that trading range before I would consider closing my trade just based on the four-stage model. In the meantime, I have my 10-weighted moving average, which is all the way up at 144, which I can use as some kind of a stop for a put placement to protect my my entry from down below. Okay. Now, I could also trade this higher trading range if I want by buying calls near the bottom of that trading range and buying puts near the top of the trading range. These are a couple of the options that I have. And, of course, I could always, if I still have my other position, I'm actually in the position to do some kind of a covered right with that. So I put the moving average on here due to the large size of the range and the rapid move higher. My 30-weighted moving average is lagging pretty badly. So it's not really offering me much protection. A trader would use that 10-weighted moving average, whereas a long-term holder waits for the 30 moving average to make his trading decisions. And right now, a 140 put can be purchased to lock in the profits from either the 104 or 108 entry. Okay. Let's move on to the British pound. So the British pound, as you can see, we were in a trading range which was a very, very easy trading range to see because of the length of time that we spent inside that trading range. So we had a big reactionary bottom low, and we've actually traded up and made a trading range here between approximately 49.50 and 51.50. And this is one of those trading ranges where I looked at something like this and I says, okay, I can buy calls at the bottom of the range, buy puts at the top of the range, sell puts below the bottom of the range, sell calls above the top of the range if I wanted some kind of an income strategy. So with this one, when I first discussed it, these were a couple of the strategies that were possible due to the size of the range and the length of the time that price had spent in the range. But you always have to plan for a breakout, okay? It traded in that 49.50 to 51.50 range for quite a period of time, okay? And the strategy that we used included buying calls and selling puts to kind of pay for it. Okay, so we had some kind of a basic strategy. And again, depending on your broker, you may be able to do that. You may have to do something along the lines of a iron condor or some kind of a butterfly because your broker won't let you, take on too much risk. So we actually did that on a different currency, not the British pound though. But we made a plan, just in case we did break out of that trading range, to use 52 calls. And that plan was executed in August. Okay? And it was easy to plan for because of the length of time that we had spent in this trading range here. You could see these highs. We've tested the highs several times. We've also tested the lows, but only once. And I want you to notice the pattern here. At the end, we actually started to make what we call an ascending triangle pattern. So it was kind of giving us a clue that the breakout, when it did happen, and the slope of the moving average, was kind of giving us a clue that we were going to break out and move to the upside from here. But it wasn't as strong a breakout as the breakout was against the Australian dollar. Okay, but it did break out, did give us an opportunity for entry, and started to move in our favor. Managed to move through the 52 level, 53 level, stalled out for a couple of weeks between 53 and 54, and then it actually did break out of the top of that range. And for a while there, we actually had a gap. Okay, and notice I've drawn some trend lines at this point. And notice the reason I'm drawing those trend lines is, and something that I try to tell every trader I trade, you make money when you can focus yourself to see when price is no longer going horizontal and suddenly becomes going vertical. Because now when you're in a trend move, you need to switch up to actually using trend lines, moving averages, indicators like the moving average convergence divergence that measure strength of trend, or the ADX indicator. Any kind of indicator that's going to help you gauge the strength of your trend. So usually what happens is I draw several trend lines. I drew long-term trend line with a less sharp angle than the short-term trend line, because the sharper price moves up, the more likely my trend line is going to be broken. Okay? And I have an oscillator down here, which is the slow stochastic oscillator, which in a trading range is a great tool. As you can see, there were several times where I was oversold at the bottom of the range and overbought at the top. Good trade signals. But now, once I've broken out of that trading range, I'm constantly going to be overbought. And if I'm constantly shorting rising prices, this is where traders lose money. So focus on the fact that you broke out here and you're moving in vertical movements now. So it was a similar move to the Australian dollar, and I was looking for some kind of a retracement at some point. Okay, and from the 8-8 breakout, we could use a protective put based on the prior week's lows. The Fibonacci price ladder, again, was a good idea. And I shall show you a couple of charts where we really didn't even retrace very much of the either the Australian move or the move against the Australian or the British pound. We could sell higher price calls once we established another trading range, but unfortunately what happens is that usually gives away upside potential early in the move. So you've got to be pretty much convinced that the move is going to stall out. And at that point in time, we had just had Freddie and Fannie get bailed out on 9/6. So anything was possible at that time. These are the kind of things, the fundamentals, that can actually throw everything you're doing into a complete mess. So you have to plan, and again, you cannot make the market do what you want to do, but you can plan around it based on the information available at the time. So here's my Fibonacci price ladder. And my rule, again, and it's a very simple one, is any kind of a strong uptrend, and I mean strong, would never retrace to me more than the 38%. And at that point in time, we were back to about 53 for the retracement place to place a protective stop or buy some kind of a protection. Okay, so that's just my personal rule. I'm sure there's other people with other Fibonacci trading rules that you're going to hear about, but my rule is we never retrace more than 38% in a strong uptrend. So that would be an ideal place to place protection.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.